Hi, I'm Benjamin Hawes of the Hawes Financial Group, where we align your personal values, vision, and wealth. Today I want to share the concept of the 9 circles. Proactive wealth transfer planning is about control and leverage. We believe that a successful estate distribution plan is one in which your heirs and/or charity receive as much as possible and Uncle Sam as little as possible. But this requires some work. Depending on your heirs' tax brackets and state of residence, almost a third of certain qualified assets could be lost to federal and state income taxes. Take this current hypothetical situation. Husband and wife, both age 59, combined current 401k and IRA balances are $750,000. They plan to contribute $15,000 annually until they retire at age 66 with the hypothetical growth rate of 4%. Primary beneficiaries each other, secondary their 3 children. They only plan to withdraw the required minimum distributions throughout their retirement. Both passed away at age 90, having taken $1,375,000 in growth distributions over time. The remaining before tax balances to their beneficiary, $950,000. Let's say that beneficiary distributions are spread out over time so as to retain the 25% tax bracket. Let's see how the assets are then distributed. Under this scenario, the IRS is like having a 4th child in that they are going to be an equal 25% beneficiary of your IRA assets. To address this, one option would be to use a portion of your IRA assets even above the RMD amount you are forced to take to purchase a life insurance policy. Because permanent life insurance is distributed tax-free, this strategy would enable you to pass more to your heirs. Here's how the more heir-centric strategy would work. You purchase a life insurance policy with a face amount of $1 million. To pay for this, you start taking IRA distributions of $15,000 a year at age 66 and continue taking distributions above the RMD amount at age 71 if necessary. If both pass away at age 90, you will have taken $1.7 million in gross distributions over your lifetimes, $325,000 of which was used to pay insurance premiums. The remaining before tax balance to your beneficiaries at age 90 would be reduced to $377,000. Beneficiary distributions on remaining assets are still taxed at 25%, but now include a $1 million tax-free death benefit. So as you can see, the taxes owed by your heirs is significantly reduced, while the after-tax legacy is increased. So, first, net of premiums, you've received nearly the same distributions throughout your retirement. Second, you've spread out the taxes owed over your lifetime. And third, you've leveraged the additional distributions into a tax-free inheritance. Now with this strategy, it's important to note that the premium amount for life insurance will vary. It's based on your health and age at the time you apply for the policy. It is also important to discuss your personal situation to determine if this strategy is right for you. But do note here, the IRS is still a significant beneficiary of your assets, and you still have yet to address the charitable legacies with this scenario. So if leaving money to a charity is your goal, let's look at this final option. Again, you could use a portion of your IRA assets to pay insurance premiums over time, just as you did in this scenario. Your heirs are still left with a significant after-tax legacy of $1 million from the life insurance. You then could choose to list your favorite charities as the beneficiary of your IRA assets. Because charities do not pay income taxes, you've essentially eliminated the IRS as a beneficiary of your estate altogether. So in summary, obtaining life insurance is not always an easy process, as one must be healthy enough in the eyes of the insured to make their risk worth their while. But the death benefit could be great leverage for your heirs. And if you're charitably inclined, there are great tax benefits to the zero tax plan shown here as well. That's the concept of the 9 circles.